Welcome to The Explainer. Today, we're digging into how one single speech from the White House sent a massive wave of fear across global markets. We're going to break down what this moment shows us about the unbelievable power of political words in an already on-edge world. All right, so let's set the scene. It's the early hours of April 2nd, 2026. As traders are getting to their desks, they see the price of Brent crude oil, that's the global benchmark, just exploding. A 6.6% jump overnight, that's not a small bump, that is a massive, headline-grabbing move. And at the exact same time oil is going through the roof, something else is dropping like a stone. U.S. stock futures, which give us a pretty good idea of how the market's feeling, took a sharp 2% nosedive. All the good vibes from the day before? Poof, gone. So this sudden, violent whiplash left investors all over the world just scrambling and asking one simple question. What on earth just happened? What could possibly trigger that kind of panic across oil, stocks, and everything else all at once?
Well, to get to the bottom of this, we've got to rewind the clock just a few hours. The trigger, it turns out, was a rare primetime address from President Donald Trump. Now, markets were hoping for a nice, calm message. What they got was, well, something else entirely.
Yeah, that quote right there, that was the sentence that shook global markets. Instead of a clear plan to de-escalate things with Iran, investors got hit with this incredibly aggressive language. It was a giant red flag that this conflict and all the economic mess that comes with it was far from over. This really gets to the heart of the issue, right? There was this huge disconnect between what the market was expecting and what actually happened. It's like investors had bet everything on a peaceful solution, pricing in calm and clarity. What they got was the exact opposite, a promise of more conflict that just threw a wrench in everything. And here's the really critical part. The speech didn't just scare stock traders. No, its impact sent shockwaves across the entire global financial system, hitting everything from oil and gold to currencies and even government bonds. This chart just lays it all out, doesn't it? You can see the panic in real time, a scramble for safety and a raw fear that supply chains were about to break. Oil surged, we saw that. But what's really interesting here is that other stuff like gold and industrial metals like copper actually fell. So what's going on? Why did they all move in such different directions? Okay, let's unpack this logic, because it's pretty interesting. The oil move is the easy one. The threat of a longer conflict means the Strait of Hormuz could stay closed, and that cuts off about 20% of the world's oil. Simple. Now, gold is where it gets a little tricky. Usually it's a safe haven, but it fell because the US dollar got stronger, making gold less attractive this time around. And then you have industrial metals like copper. They got hit with a double whammy, fears of a slowing global economy, plus a direct threat from the president to attack Iran's infrastructure.
Over in the currency world, we saw what traders call a classic risk-off move. Think of it like a global stampede for safety. Money rushed into the US dollar, which is kind of seen as the world's ultimate safety blanket in times of trouble. Meanwhile, European currencies like the euro and the pound got weaker, mainly because their economies are way more exposed to those big energy price spikes.
And, you'd think the super stable world of government bonds would be a safe place to hide, right? Well, not this time. The idea that oil prices could stay high for a long time brought back old fears about inflation, and that spooked investors into selling U.S. Treasury bonds. When that happens, the interest rate, or the yield, on those bonds goes up, signaling that borrowing money could get more expensive for everyone. Okay, so we've covered the markets. Let's zoom out now and look at the bigger picture, the huge diplomatic headache this rhetoric created. With the U.S. taking a much tougher line, the job of actually fixing the problem is now falling on everybody else. In that speech, President Trump made one thing crystal clear. Securing the Strait of Hormuz, that vital shipping lane, was no longer America's problem. He essentially tossed the keys to European and Asian allies and said, hey, it's your job to protect your own oil shipments now. So, you can imagine the scramble, right? This has forced a coalition of 35 other nations, led by the UK, to quickly try and figure out their own plan. They're basically working through this really tough playbook that starts with talking, then moves to sanctions, and keeps military action as the absolute last resort. But there's a huge issue with their second option, economic sanctions. See, Iran is already under some of the most intense international sanctions imaginable. It kind of leads everyone to ask, how much more pressure can you really apply? And would it even work at this point? It's a real head-scratcher. All of this geopolitical fog brings us right back to the markets.
So with so much uncertainty floating around, how are the big-time investors, the folks managing billions of dollars, supposed to handle this new reality?
And you really have to appreciate how much things have changed. A year ago, on what the president called Liberation Day, the biggest risks on investors' minds were things like tariffs and trade wars. Today, the entire conversation is about actual war and geopolitics. It's a completely different universe, and it forces everyone to rethink what risk even means.
So you've got these big banks like HSBC creating playbooks for two very different futures. They're telling their clients to get ready for either. In the positive scenario, if the conflict gets solved, they think the US dollar will get weaker and gold will go up. But in the negative scenario, a long, messy conflict, they expect the total opposite. The dollar gets stronger and gold keeps falling.
And look, this isn't just theory, okay? Investors are making real, tangible changes to their portfolios right now. They're moving into shorter-term bonds to cut down on risk. In the stock market, they're sticking with strong U.S. tech companies that can weather the storm and getting nervous about businesses that rely on consumer spending, because higher gas prices hurt. And on a global scale, they're pulling back from big energy importing countries like India.
And this leaves us with the ultimate takeaway, doesn't it? The line between a political speech and your own bank account has never been thinner. In a world where one single sentence can move billions of dollars, the real challenge for all of us is figuring out how to separate the loud noise of rhetoric from the hard reality of risk.